Here's a clear comparison of two software platforms. An AI voice continues from here. Let's start directly with Simply Safe Dividends pricing, because this platform is positioned very clearly as a premium dividend research service, not a general purpose portfolio tracker. Simply Safe Dividends is priced at $39 per month, billed annually at $468 per year. There is no discounted entry plan, no flexible monthly downgrade path, and no complex tier structure to navigate. You either subscribe at the full rate or you don't. That pricing alone makes its target audience obvious. Long-term income investors who prioritize dividend safety, stability, and risk control over keeping subscription costs low. At this price point, users receive unlimited portfolios, full access to the platform's proprietary dividend safety scores, alerts for dividend increases, cuts and suspensions, and detailed income calendars with forward-looking forecasts. Simply Safe Dividends also includes analyst-written research reports, valuation charts designed to help investors avoid overpaying for yield, and financial charts with up to 10 years of historical data. Stock and closed-end fund screeners allow users to filter opportunities based on yield, dividend growth history, safety scores, valuation metrics, and income consistency. The platform's philosophy is clear. Avoiding dividend traps is more important than chasing the highest yield. Feature-wise, Simply Safe Dividends is built almost entirely around risk reduction and income durability. The dividend safety score sits at the center of the experience, combining cash flow coverage, payout ratios, earnings trends, balance sheet strength, and recession performance into a single, easy-to-understand signal. Income calendars and forward projections help investors plan cash flow months or years ahead, while real-time alerts notify users when dividend policies change. Analyst commentary adds qualitative context explaining why a dividend may be safe or risky, rather than leaving investors to interpret raw numbers on their own. Where Simply Safe Dividends truly shines is clarity and guidance. It translates complex financial risk into actionable insights, which is especially valuable for retirees, near retirees, and conservative income investors who care more about preserving income than maximizing returns. The platform removes much of the guesswork around dividend reliability and emphasizes consistency, sustainability, and long-term income preservation. That said, the downsides are just as clear. The price is high compared to most dividend tools, especially portfolio trackers and income dashboards. There is no lightweight or budget option for casual investors, and the platform is not designed for transaction tracking, portfolio rebalancing, performance attribution, or total return analysis. Investors who want hands-on portfolio mechanics, frequent trading insights, or detailed allocation analytics will likely find the tool restrictive. The strengths of Simply Safe Dividends are its focused research, safety-first philosophy, and structured guidance. It's ideal for income-focused investors who want confidence, discipline, and professional insight built into their decision-making. The weaknesses are cost, limited portfolio mechanics, and reduced flexibility for investors who prefer a more DIY, data-driven workflow. Now shifting to Acorn's pricing, this platform operates in a completely different category. Acorns is not a dividend research platform and not a traditional portfolio tracker. Instead, it's an automated micro-investing and saving app designed to help beginners start investing with minimal effort. Pricing is tiered and subscription-based rather than asset-based or transaction-based. Acorn's Bronze is priced at $3 per month and includes an investment account with an expert-built, diversified portfolio, spare change investing through roundups, and access to an Acorn's later retirement account. This tier is aimed squarely at beginners who want to start investing passively without needing to choose stocks or manage allocations. Acorn Silver costs $6 per month and builds on Bronze by adding additional financial tools. This includes everything in Bronze, plus access to Acorns Later with a 1% IRA match on new contributions during the first year. This tier targets users who want both investing and retirement saving incentives without stepping into advanced investing decisions. Acorn's Gold is the top tier at $12 per month. It includes everything in silver plus a 3% IRA match during the first year, an investment account for kids with a 1% match, and the ability to customize portfolios by adding individual stocks and ETFs. Feature-wise, Acorns focuses on habit building rather than analysis. The Roundups feature automatically invests spare change from everyday purchases, which lowers the psychological barrier to investing. Portfolios are pre-built and automatically rebalanced, removing the need for users to make allocation decisions. Acorns also emphasizes financial education through short lessons and prompts designed to encourage consistent saving behavior. However, Acorns does not focus on dividends, valuation, or income planning. There are no dividend safety scores, no income forecasts, no yield analysis, and no screening tools. Users don't analyze businesses or assess risk at the stock level. Instead, Acorns assumes that long-term investing success comes from automation, consistency, and behavioral discipline rather than research. The strengths of Acorns are simplicity, accessibility, and behavioral design. It's ideal for beginners, students, or anyone who struggles to start investing and wants a set and forget approach. It also works well for users who want passive exposure without monitoring markets or making frequent decisions. The downsides are lack of transparency, limited control, and ongoing subscription costs that can feel expensive relative to small account balances. Advanced investors may find Acorns too restrictive, and dividend-focused investors will find almost no tools relevant to income analysis or dividend strategy. Looking at public perception, Simply Safe Dividends shows a Trustpilot rating around 4 stars, though based on a very small number of reviews, which means it should be interpreted cautiously. Acorns has a much larger review base on Trustpilot, with an average rating around 3.7 stars. Feedback is mixed, with users praising ease of use, but often mentioning fees, account closures, and customer support issues. Ratings can change over time and should always be checked directly. Final takeaway: if your priority is protecting dividend income, avoiding painful dividend cuts, and relying on structured research rather than automation, Simply Safe Dividends is the stronger and more conservative choice, built for long-term income confidence. If your goal is to start investing effortlessly, build consistent saving habits, and let automation handle everything with minimal decision-making, Acorns fits a very different need focused on simplicity and behavior. If this comparison helped, hit like, subscribe for more honest investing, software breakdowns, and click the link below to explore the platform that actually matches how you save, invest, and build wealth over the long term, whether you want research-driven protection or hands-off automation.